investors, whether you have institutional assistance or you're doing it on your own, requires some homework. But there's a lot of issues out there, especially headwind issues, Jim, that no amount of homework is going to enlighten an investor. What do you tell clients, and what are the biggest risks you see out there where it's just hard to garner the truth on how it'll affect your portfolio?
So in terms of portfolios, one of the hardest risks to really hedge for is a binary risk. And I think that there are two major binary risks that are out there. One is China and trade and tariff talks, and the other is what's going on in Europe with Italian politics, the EU budget, and all of the volatility that could actually cause. Now, we've seen what's been going on, but the reality is that between now and the end of August, as far as U.S., China, and tariffs go, we're not going to really know anything until the beginning of September. So what do you do between now and then? And it's the same thing with what's going on in Italy. A lot of these talks around the budget, that's going to take place into September. If those things go through and everything's okay, I think it's a very strong risk-on environment. But if they don't, it could go the opposite way. So the key here for us is to really build a durable portfolio where we can withstand the volatility and be able to add opportunistically when the events actually, create themselves.
Now, let's keep it real simple here. But, there was a time when an investor would look at various headwinds and think most likely they'll have negative effects for equities, which used to mean positive effects for purchasing treasuries in a safe harbor fashion. Are today's binary risks going to move in the same direction in those two markets, in your opinion?
In my opinion, I think things, Rick, have become very, very highly correlated. So in other words, if good things are happening, if these binary risks come out to be positive, bond yields are going up, but also equities are probably going to go up too. So it's not that high bond yields necessarily hurt the equity market. It's always a reason as to why those yields are going higher. If it's good for good reasons, that's fine. Equities has a good tailwind, good earnings, fiscal, taxes, all these various things. So I don't see necessarily a movement higher in interest rates as necessarily hurting equities. But if we do have a risk-off event, which would mean that rates go down, equities probably also fall as well. So I think we're in a very high correlation environment. This makes it very challenging to create a diversified portfolio between equity and fixed income. So,
okay,
like
Jim,
I said,
we're out of time. I just want a kind of a yes or no answer to the following. Does that mean, in your opinion, that maybe that's one of the reasons 3% is so elusive, because there's buying based on some of those binary issues? Kind of a yes or no?
Yes, absolutely.
Okay,
that is
excellent.
the reason.